The ETF menu has continued to expand. The mutual fund menu, by comparison, has been shrinking for over a decade now. So if you want to get a glimpse into ETF's future, I don't think you have to look much further than mutual funds in that respect.
How do we get from this world where we've got the spaghetti cannon in full force, everything is getting launched?
Fast forward, call it 10, 20 years from where we're at today, we're gonna see that most of that pasta didn't stick and has fallen to the floor.
ICI Conference 2026, holy cow, it's been a big one, huh?
It has been a big one.
This came out of nowhere. I wasn't here last year. Were you here last year?
I was not here last year.
So we're both
this is my
coming in
first.
cold.
Absolutely, like as cold as people like you and I who've been around this industry for years now could possibly come in cold, yes.
There is a lot of the seeing every single person who works in this industry all in the same place, and that can be a little overwhelming.
Absolutely.
But this industry has just exploded. Part of what struck me was every person here I either know or is under the age of 30.
Yes. Yes.
And that's great, right? The health of the industry is huge. Hot topics. What are you taking away from this that's at all surprising to you?
Well, I think related to what you've just said, Dave, is we've reached this moment in the industry's history where it's all grown up. We're talking about thousands of products and trillions of dollars and $1 trillion+ worth of net new money coming into ETFs last year. We'll probably hit that number very shortly, barely past the midway point of 2026.
Probably get 1,000 funds this year.
Absolutely.
Yeah.
So ETFs have more than arrived at this point. And what's been notable to me is that some of the sessions are almost already looking past ETFs to what might be next. There was a session, for example, on day one that focused around the topic of tokenization.
Right.
Tokenization is no different from ETFs, just a new and different and maybe more efficient access point for all form of underlying assets and strategies, ultimately even vehicles, right? Maybe as an access point for ETFs or ETFs that become tokens unto themselves. So really, fundamentally, all we've ever been talking about in this industry is just packaging. What is the better wrapper? The better wrapper today, and here is where I often draw on my Heinz ketchup analogy, we've moved past the glass bottle that you have to hold at an 8-degree angle and hit with 12 PSI of force to get all of your ketchup out. We've now adopted with open arms the topsy-turvy plastic squeezy bottle that is the ETF. So I think the question is there something that comes next that further disrupts just fundamentally the way that we package, distribute, consume all form of different investment strategies, exposures from crypto to total stock market index and all things in between.
And it's great to see the ICI leading there. I mean, I think the ICI has always been a phenomenal organization. They do great research, but it hasn't always been incredibly obvious what the future was going to hold and whether it was going to be mutual funds, which is the ICI's mandate. Here, to your point, there seems to just be a very broad acceptance that, okay, we're talking about on-chain asset allocation, we're talking about tokenization, we're talking about things that bridge out of the US ETF infrastructure and into foreign markets. And that hasn't really traditionally been the ICI's kind of lane. So it's really great to see them kind of becoming an innovation hub for this industry.
Absolutely, and credit to the organization for really not just getting with the times, but now looking beyond the times and accelerating. And that applies to the fact that we're here in the second year of their exclusive ETF event, that at this ETF event, they're already looking beyond ETFs into things like tokens. They're expanding their remit into other forms of investment wrappers as well. Let's not forget that in this saga that I often tee up as life after mutual funds, ETFs might be playing a starring role, but long before ETFs were putting their straw in mutual funds milkshake, we saw CITs begin to get traction in retirement channels. Separate accounts have been with us for a long time and are getting new wind in the form of delivering very sort of tax-focused tax optimized outcomes for high net worth individuals. So I think the ICI gets a lot of credit now for not just catching up with the times, but looking beyond, around the next corner to what might come next.
Well, let's talk about some of the what's coming next. One of the things I love about you is following you on social media, where you keep track of several things aside from just making spaghetti hand pictures to talk about the next launch, right? But you've done a lot of tracking on the share class relief that now we're up to 100, probably more. You've been tracking it post by post. We've seen an enormous number of folks file for it, but we actually haven't seen quite the raft of launches that I was expecting. What do you think the delay here is?
There's a big delta, right, Dave, when you look at the numbers. So as soon as I posted my latest update, this was last Friday, 4 more firms filed. So we're now at 104 firms in total that have filed for this exemptive relief, but just 4 have actually taken the plunge and either launched an ETF share, and then FM went the other way and launched a mutual fund share of their ETF. There's just so much work to do in the innards of the industry to get the plumbing right. And there's meaningful, I think, modifications, innovations that are happening in real time. I think most notably with the DTCC now launching kind of a core capability to help make mutual fund shares and ETF shares every bit as fungible via, in-kind sort of transfers from one class to another. But there's still more work to be done downstream. So I think most of the filers are still very much in wait and see mode. They've got a call option that they're going to hold on to until they decide that maybe they let it expire or maybe they exercise it. And when they exercise it, I think they'll follow a pattern that we're already seeing playing out, which is they're going to be very selective. They're going to look at this by a fund basis, a shareholder base by shareholder base basis, and do ultimately what's in the best interests of all fund shareholders.
We've seen a bunch of folks kind of just skip this route and just convert.
Wholesale conversion.
And absent a big retirement bucket that you really can't convert out of. I'm getting that vibe more and more as I talk to the lawyers who were all here, some of the service providers, that, hey, look, if you don't have your hooks in the 401k market, you can do a full conversion really easily, really cheaply. Is that taking some of the wind out of the sails on the share class front, do you think?
I think to a degree, Dave. I think, it's not either or. It never has been, never will be. It's kind of both and. And you're seeing exactly that in the case of, say, Dimensional, which has done both. They've converted wholesales, some of their specifically tax-managed mutual funds, which were probably the most obvious candidates for conversion.
None of those were in a single IRA ever.
Absolutely. But simultaneously, they've launched ETF shares for a pair of their mutual funds. They've launched standalone ETFs that are effectively clones of predecessor mutual funds. So I think it's going to be very sort of selective and situationally specific when you look at how asset managers are going to approach all of these different potential access points that they can offer their investors to their end strategies.
Let's talk a little bit. You said access points. I'm going to grab that word, access. We're now in a world where products like DRAM are getting a $100 charge ticket if you go to Fidelity. That whole pay to play for shelf space is very much on top of us now. At the same time, you've got folks like Schwab kind of getting into the advisor business a little more directly, actually opening their own advisor offices for the first time. There's a lot of moving pieces on the distribution plane here. Do you think that, folks like Roundhill, like one of the only notable holdouts there, do you think that they'll ever be successful in sort of grinding away at this revenue share flood that we've seen out of distribution? Or do you think this ship has sailed and nobody deserves a space on the Walmart shelf without paying for it?
Well, I just think what we're talking about is a tale that's as old as time in our industry. This is a model that's existed for a long period of time. And there was a moment where ETFs were able to almost do an end run around some of these economics with respect to distribution. It's almost as if, I made up my own lemonade stand and, parked it in end cap in Walmart until somebody caught me doing that.
What was happening was growing so fast that people like Fidelity kind of gave up and said everything trades commission free because they couldn't get away from the wave.
Exactly. I think a lot of those key distribution platforms are looking back at that and saying, is this right? They're now facing just an absolute wave of new product, right? 5,500 plus ETFs, now surpassing trivially speaking, no meaning here at all, but surpassing the number of US listed stocks.
Right.
At the rate we're seeing new launches coming out, ETFs will actually outnumber mutual funds in the US probably around this time next
about
year.
a year or two, right?
So just the wash of product, everything that has to happen with respect to curation and diligence, and also just, when you look at the incremental complexity of what's coming to market, I buy that there are real costs involved, but more fundamentally, there's just a real economic model that's been with us for ages, exists in other contexts, like Walmart,
Right.
that I don't think is going away, but I think nonetheless, you're going to see any number of issuers bring innovative product to market that will succeed against all odds.
Well, some of it will. I mean, we've got, as we record this, SpaceX goes live on Friday. We have 7 funds that have already said they'll be live the second SpaceX is trading, which is a first, right? Generally speaking, people don't call their shots on when their ETFs start trading because something always goes wrong and you think it's today and it's next Tuesday. Happens all the time. Now we've got companies actually calling their shots on the moment that their ETFs are going to start trading. Obviously, all 6 or 7 of those ETFs are not going to be runaway successes. How do we get from this world where we've got the spaghetti cannon in full force, everything is getting launched, a bunch of it's just not going to be successful? Are we going to end up in a world with 1,000 closes in a year or two because a bunch of these funds don't work?
I think absolutely. If you fast forward, call it 10, 20 years from where we're at today, we're going to see that most of that pasta didn't stick and has fallen to the floor.
Right.
And you see that manifest right now with respect to what we're seeing in the mutual fund menu. So if you just look at the pattern in net new product, so new launches minus closures year on year, going back to all the way back to the dawn of the ETF era, the ETF menu has continued to expand. The mutual fund menu, by comparison, has been shrinking for over a decade now. So if you want to get a glimpse into ETF's future, I don't think you have to look much further than mutual funds in that respect. That's not to say that the industry won't continue to be healthy. It's just that there's going to be a long tail of product that just proves not to pan out, not to meet a true investor need.
Well, if nothing else, it keeps us entertained. Thanks very much.
Absolutely.
Cheers.
Thanks, Dave.